Investing in different stocks or ETFs that offer a higher starting dividend yield from day one is something that every single dividend investor has either done or thought about, especially during the early days of their investing career. Now, in this video, we are going to dig into my actual dividend growth portfolio, which currently pays me over $75,000 per year in dividends and over $6,200 per month in dividends. And I'm going to share with you some of the biggest mistakes, some of the different stocks and ETFs that I purchased, for the most part solely chasing a high dividend yield. And I'm going to share with you some of these mistakes in the hopes you don't make them also. So if you're currently building out a long-term dividend growth portfolio, make sure to stick around. I promise this is going to be beneficial. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So like I touched on, this right here is basically every position more or less across my multiple portfolios, and I've been investing for around 7 or 8 years now. Now, as of right now, I currently have around 40 different positions, different stocks or ETFs that all pay me dividends on a monthly or quarterly basis, and for the most part have the potential to grow on top of that. Now, there's definitely names in here that are more growth focused and income focused, but there are names in here that I definitely regret buying and that I think for the most part I got sucked into because of the yield offering. Now, the first position in this portfolio that I regret buying is ticker symbol VZ or Verizon Communications. I currently have around 1,262 shares of Verizon with an average cost of around $53 per share. Now, I purchased these shares of Verizon several years ago, which you can probably tell because the average cost per share is so darn high. Now, I bought my shares of Verizon years ago because Verizon was offering a well above 4% starting yield, and back at the time when I bought Verizon, there really weren't all that many options that were offering that sort of yield, and I thought that buying hundreds of shares of Verizon, that I also thought was sort of the top of the game as far as telecommunications, I thought Verizon stock would continue to trade up into the $60, $70 range and pay me a nice juicy dividend every quarter, but that just wasn't the case. Now, even though throughout the years I've been earning say around $700 or $800 every single quarter in dividends from Verizon, which definitely has made up for a lot of the losses as far as paper losses, which I'm down currently around $10,000 if I were to sell today. On top of that, I've been selling covered calls on my shares of Verizon, so I definitely have recouped most of the paper loss, which I'm very proud of. But the reality is that telecommunications as a whole is sort of a dying industry, at least it seems in my opinion, and there definitely at that time, and as of right now, were much better opportunities than dumping this much capital into something like Verizon stock. Another major mistake that I purchased a while back, and this is again chasing a higher than average dividend yield, was ticker symbol MPW or Medical Property Trust. Now, luckily for myself, I just purchased over 600 shares of MPW, but at an average cost of over $17 per share, which MPW right now is trading at just over $4 per share. Which means as of right now, I'm down around 75% on my shares of MPW, which again, here comes some cope. I also got dividends along the way for the last few years. And on top of that with MPW, I also sold covered calls, but still I'm down quite a bit. Now, I bought into MPW because I saw that hospital REITs, medical REITs, that sort of thing were sort of having some struggles, and I thought it could be a great buying opportunity because as the price was down so much, and in retrospect, I thought the price at $17 per share was down quite a bit from the most recent highs, and I thought that locking in a nice starting yield would be something that could help me later down the line. But since then, if you hold MPW or ever heard about it, they did cut their dividends significantly, and the dividend yield that could have been around 20% is now just pennies on the dollar. MPW is another example of me investing into an industry that I sort of saw the writing on the wall, had a lot of issues, but because of the yield, I went ahead and started buying it and chased it down, at least not too long though. Another instance of chasing a higher yield, even though I sort of knew better, was when I bought around 89 shares of Walgreens, ticker symbol WBA. Now, I bought a bunch of shares of Walgreens back in the day with an average cost of around $36 per share. Walgreens as of right now is basically trading at half of that at $19 per share. Now, luckily in the grand scheme of my entire portfolio, 89 shares of Walgreens, of course, isn't going to either make or break the portfolio, but still this is another example of a single stock that I sort of thought to myself, is Walgreens really going to be making tons of profit 10 years, 20 years from now? Or is Walgreens sort of a dying brand? Along with the fact that Walgreens has announced that they've been going through some crazy things just in the last few years. But even still, I decided to go ahead and buy 89 shares of Walgreens at an average cost of almost $40, which since then, as you know, Walgreens has been an absolute dumpster fire. But because of the high yield, I once again chased it, luckily only chased it for 89 shares. Another perfect example of chasing something that doesn't seem very sustainable whatsoever, but is offering a mega high dividend yield is my 255 shares of TSLY, which now post the reverse split I'm down substantially on. Now, I originally bought my shares of TSLY sort of as a fun little gamble. I'm not much of a gambler. I don't buy scratch-offs. I don't go to the casinos. So I thought to myself, when these yield max ETFs came out, I thought it'd be sort of fun to grab some shares and just see what happens and just have some fun with it. And luckily, I only grabbed a few hundred shares. I remember seeing people on Twitter and on YouTube that were selling their entire dividend growth portfolios and going all in on these yield max ETFs. Now, luckily, I had more restraint and I did not do anything of those sorts, but still, my few hundred shares of TSLY, I'm basically down 50% on. Yes, I earned some nice dividends along the way, but could that money been much better sitting in something like SPY, SCHD, DGRW? The answer is yes. But because TSLY, along with a lot of the other yield max ETFs, were offering these shiny, juicy dividends, I would assume some of you guys watching, including myself, got sucked into it. But again, in retrospect, I'm just happy that I only purchased around 255 shares of TSLY, considering, like I said, I saw a lot of dividend investors investing much, much more. Now, there's definitely other positions in this portfolio that I sort of chase somewhat for yield, things like JETB ETF or even things like QYLD, which turned out to actually trade for the most part pretty well over the long term, although of course I'm not saying that they were the perfect investment whatsoever. But for the most part, throughout this portfolio, I'm very happy to say that I do own things like Apple stock, I own a ton of Realty Income, I also own a ton of SCHD, JP Morgan, etc. And I think that in the long term, every investor is probably going to make some investments into different stocks or ETFs that they might be ashamed of, and some investments that they are very, very proud of. The whole idea is to win a lot more than you lose, though. Now, this should of course go without saying. There are some very high yielding stocks and ETFs that have been historically and are currently great investment opportunities and choices. But I know that when I was a newer investor, I definitely favored anything and everything that had a high starting yield. And now after 6 or 7 years of investing in the stock market, I obviously know now at this point that just because a stock or ETF has a high starting yield does not necessarily mean it's a good investment option. But those are some of the names in my portfolio that I definitely wish I would have never invested into in the first place, with the shiny object of the dividend yield that was higher than most. But lastly, now I want to hear from you guys down below. When it comes to your dividend investing career, what are some ETFs or some stocks that you purchased for the most part solely because they were offering a higher than average dividend yield and that you regret deeply? Be honest, drop them in the comments down below. If you enjoyed this video, make sure to please drop a like down below, subscribe, and I'll see you in the next one. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.